Are you tired of renting and dreaming of the day you can finally paint your own walls and plant a garden? Owning a home is a significant step towards building a secure future for yourself and your family. But before you dive into home ownership, there's one crucial thing you need to understand: mortgages. A mortgage may seem like a scary word, but it's not as complicated as it sounds. In the simplest terms, a mortgage is a loan that you take out to buy a home. It's like borrowing a large sum of money from a lender with the promise that you'll pay it back over time, usually 15 or 30 years. This loan is secured by the home itself, meaning if you fail to make your payments, the lender has the right to take possession of your property. Think of it this way: the mortgage is the financial foundation of your home ownership journey. Over the course of your mortgage, you'll make regular payments that consist of two main parts: principal and interest. Principal is the portion of your payment that goes towards paying down the actual loan amount, while interest is what you're paying the lender for the privilege of borrowing their money. Just like there are different cars for different needs, there are various types of mortgages designed to fit various financial situations. Let's explore a couple of the most common ones. First up, we have the fixed-rate mortgage, a crowd favorite. With a fixed-rate mortgage, your interest rate remains the same for the entire life of the loan. This predictability makes budgeting a breeze. On the other hand, we have adjustable-rate mortgages, or ARMs. ARMs start with a lower interest rate but can fluctuate after an initial period. This means your monthly payments could go up or down in the future. Choosing the right type of mortgage depends on your circumstances and financial goals. If you crave stability, a fixed-rate mortgage might be the way to go. But if you're comfortable with more risk, an ARM could save you money in the long run. Now, before you fall head over heels for a charming Victorian mansion with a sprawling lawn, let's talk about how much house you can actually afford. Don't just listen to what a lender tells you. It's crucial to be realistic and determine a comfortable budget that aligns with your income, expenses, and financial goals. Lenders use a tool called the debt-to-income ratio, DTI, to assess your borrowing capacity. Your DTI is the percentage of your gross monthly income that goes towards debt payments, including your potential mortgage payment. Most lenders prefer a DTI of 43% or lower, but remember, this is just a guideline. Take a close look at your monthly spending habits. Identify areas where you can cut back on unnecessary expenses and redirect those funds toward your mortgage payments. Remember, owning a home should bring you joy, not financial stress. Factor in additional costs like property taxes, insurance, and maintenance. These costs can add up quickly, so be prepared. Your credit score is like your financial report card. It tells lenders a lot about your credit worthiness. A higher credit score generally translates to more favorable loan terms, including lower interest rates. For most conventional mortgages, a credit score of 620 or higher is generally required. However, different loan programs may have different credit score requirements. For example, government-backed loans such as FHA loans often have more lenient credit score requirements. If your credit score isn't quite where it needs to be, don't despair. There are steps you can take to improve it, such as paying your bills on time and reducing your credit card balances. Before you start shopping for a home, it's wise to get pre-qualified for a mortgage. Pre-qualification is like a quick checkup for your finances. You provide a lender with some basic information about your income, assets, and debts, and they'll give you an estimate of how much you might be able to borrow. Pre-approval, on the other hand, is a more formal step. With pre-approval, a lender reviews your financial situation in detail, including your credit history and income verification. If you're pre-approved, the lender will provide you with a conditional commitment in writing, stating the loan amount they're willing to lend you. It shows sellers that you're a serious buyer and can give you a competitive edge in a hot market. Closing costs are those pesky fees and expenses paid at the closing of a real estate transaction. These costs can include loan origination fees, appraisal fees, title insurance, and more. It's a good rule of thumb to budget for around 2% to 5% of the purchase price. Remember, closing costs are a necessary part of the home buying process. If you're making a down payment of less than 20% on a conventional loan, you'll likely need to pay for private mortgage insurance or PMI. PMI protects the lender in case you default on your loan. The good news is that PMI isn't forever. Once your loan-to-value ratio reaches 80%, you can request to have PMI removed. Interest rates can fluctuate like the stock market, so it's only natural to want to secure a favorable rate for your mortgage. That's where an interest rate lock comes in. An interest rate lock is typically valid for a specific period, such as 30 or 60 days. Keep in mind that interest rate locks can vary from lender to lender, so be sure to shop around. Now, who wouldn't love to be mortgage-free sooner rather than later? The idea of eliminating that monthly payment and having extra cash flow is certainly appealing, but before you start making extra payments, it's essential to weigh the pros and cons carefully. One of the biggest benefits of paying off your mortgage early is that you'll save a significant amount of money on interest payments. Even small extra payments can add up to big savings over time. However, there's also the opportunity cost to consider. Before making any decisions about early mortgage repayment, assess your overall financial situation, goals, and risk tolerance. Life happens, and sometimes unexpected events can make it challenging to keep up with your mortgage payments. But it's crucial to understand the potential consequences of missing a payment. If you miss a mortgage payment, your lender will likely charge a late fee. Repeated late payments can damage your credit score, making it harder to obtain loans or lines of credit in the future. Many lenders are willing to work with borrowers facing hardship to explore options such as loan modification or forbearance. Choosing the right lender is just as important as choosing the right home. Take the time to shop around and compare offers from multiple lenders. Don't be afraid to ask questions and negotiate for the best possible terms. Pay close attention to interest rates, lender fees, closing costs, and customer service. Choose a lender you trust and feel comfortable working with. Navigating the world of mortgages may seem daunting at first, but armed with the right knowledge, you can approach the process with confidence. Remember, knowledge is power, and understanding mortgages is essential for making sound financial decisions.